Jason and Eric, thank you so much for coming on today.
Thanks, Elijah.
Great to be here.
All right. Now, I'd first like to discuss the precious metal markets, because this week, I guess if we wanted to start with Jason's perspective on the price action in the precious metal markets, it seems like we're pretty much flat for the week, if not a little bit down.
Yeah, and I think there's a divergence here that's been going on for a while now. I've been thinking about this more the last couple of weeks, calling it manipulation arbitrage. So I don't know if this is all central banks manipulating paper precious metals prices, or if it's the bullion banks combined with maybe private sector Chinese speculating. But there's been in the past, there was a very positive correlation between copper and silver, and that correlation for a while now has seemed to be that positive correlation has seemed to be getting less and less, where copper had very, very strong rallies for a while and silver was not moving up. So it's very frustrating for me. And, you know, the bullion banks and the central banks who have the stake in manipulating precious metal prices, they may have an incentive to do this. But if you think about it from a manipulation perspective, and maybe they're just this is an effect of China stockpiling copper. But really, if you can keep the copper price high, there's a lot of silver byproduct that is available, a lot of extra supply. And if you look at the fundamentals of the primary silver miners, they're not doing very well. Last month was the Denver Gold Forum, which is one of the best conferences there is for your listeners out there who want to research how the industry is doing. And First Majestic Silver, which is one of the lowest cost primary silver producers in the world, you know, they've been having problems the last couple quarters continuing to cut costs. And the more you look at mining companies, I think mining companies cannot perpetually cut costs and maintain high levels of production. They have been able to do this for the most part during this paper bear market since 2011, but you can't do this indefinitely. So I think we're close to hitting a wall with the regard to the paper metals prices, Elijah. You know, you mentioned they're having problems. You know, it seems to me every time gold goes up $30, you know, when it's about to break out, and it just keeps getting knocked back down. The same thing for silver. And, you know, we have these cryptocurrencies which don't have the manipulation that gold and silver do. And these things, you know, just seem to catch a bid. People are buying the dip strong. This is what was happening during the precious metal bull market prior to 2011. And so the mining company shares, if I could get something in before I'll pass the baton to Eric, the mining company shares, I'm looking at the Sprott Junior Gold Miners ETF, which is SGDJ. And since January, it's tried to break out 3 times and it's been capped 3 times. So it's kind of in a trading range. It's trying to make higher lows, but it just can't break out above key levels, and it just keeps getting knocked back down. So I think the industry, you know, is going to keep on trying to figure out how to tread water. But the primary gold miners at this point are in a lot better shape, because they have better margins than primary silver miners, at least for a while. But there's still a lot of long-term problems with both industries. So they can't perpetually cut costs. And, you know, unless demand for physical metal drops, and we don't see evidence of that, there's going to have to be in the next couple of years some return to reality, where the miners are going to be able to, they need a higher price. So basically 1,400, 1,500 gold and 25 to 30 silver. We're going to have to see this in the next 2 or 3 years, I would say, or the industry is just not going to be able to produce at the levels they are now.
Now, turning to you, Eric, do you see so basically what Jason is saying, if we don't get $1,400, $1,500 gold, the mining industries are going to be in big trouble. Do you see that happening, you know, in the next couple of years? What is your perspective?
I think that chain reaction would, in fact, happen, but the prices will move above those levels even in the next couple of years. So the mining industry is going to have its bacon saved. The reality is that you know, it's harder and harder to find high-grade deposits. Costs are going up. Size of deposits are, generally speaking, smaller. And these are trends that have been going on for decades. And we have hit a phenomenon commonly called, in derisive tones by some, peak gold. And that's just where we are. And the same thing is existing with silver, and the industrial uses of silver are growing very, very rapidly. When the switch flips in the West, where people are going to be interested in using gold and silver as safe haven assets, when people's perceptions of general assets like the stock market and the bond market turns around and people are fearful as opposed to being stupid and greedy, that's when the alternative assets are going to start screaming higher. And we're going to hit that at some point. But, right now we are in a very manipulated market. The precious metals are following expectations of interest rate differentials and the way people perceive what various central banks are going to be doing vis-a-vis their balance sheets and their interest rate policy. And so, right now we're going through this period where people are rushing back into the dollar. We've seen it for a couple of weeks now, and it's just, these are the kind of machinations that go on in these markets. And for the time being, we're getting a lot of pressure in precious metals, but the stock market is going to roll over at some point. The economics and fundamentals are not there to support it, and markets just don't grow to the sky. We've made that point over and over again ad nauseum, and it's just the way it is. The markets are continuing to move higher because we have $150+ billion worth of liquidity flowing into the markets from central banks every month. And if you, depending on how you calculate stuff and which banks you add, you can get up to $300 billion per month. So, the central banks are going to curtail some of this flow next year. They're starting now. They're going to have to stop at some point because the entire financial market edifice that they've built is going to come crashing down if they cut off the spigots. And that's where we are. And we are always frustrated by, looking at how it's impossible to time these things and have egg on our face as forecasters looking at the object reality that we face, but that's just where we are, and that's the kind of liquidity flows that the Federal Reserve and ECB and all the other banks are pushing into the markets to create this alternative reality. It's like the Twilight Zone.
Yeah, and hedge fund managers, to add to Eric's points there, hedge fund managers are calling this the everything bubble. But in my opinion, I would amend that just a little bit. I'd basically say everything but gold and silver and mining shares is in a bubble and is basically going higher. People are buying the dips on all these things. So we could just talk about the major asset classes like the stock market. The Dow went from 22,000 to 23,000 in record time. It's almost to 24,000 already in even faster record time. And all the Dow companies are not doing well. So it's only a couple companies that are doing well. It's mostly the FANG stocks, Facebook, Amazon, Apple, Netflix, Google, that are doing well and moving the indices up, or Goldman Sachs occasionally. Goldman Sachs, as we know, because President Trump, 3 or 4 of his main advisors are Goldman Sachs people. The people who voted for Trump did not vote for Goldman Sachs people, I assure you. And so, the other is neocon Marine generals. So when you look at the other major stock market index, which is the S&P 500, only about 10% of those companies in the S&P 500 are in uptrend still. 90% of them are in pronounced downtrends. They are not, for multiple quarters in a row, having good revenues, earnings. They're missing and lowering guidance and not doing well. And yet the indices continue to rise. So maybe, Eric, if you're a hedge fund manager out there or an aggressive trader, maybe the manipulation trade here, the hedge manipulation trade is long the Dow with options, call options, long the S&P 500, and then you go and do your fundamental research and find the laggards, the companies that are actually, totally bombing these things. So then you could take advantage of this central bank and leverage short volatility trade that's being piggybacked on top of the central banker interventions. And then you go and the companies that the market recognizes are having bad quarter after bad quarter, you can go and make money there too. But the other major asset classes, let's just talk about them briefly too. Real estate market. Eric has been covering this. The Australian real estate market, housing is god awful. There's been an enormous amount of Chinese money that has leaked into there. There's huge housing and property bubbles in Vancouver and Toronto, also in London. Some of these are starting to break. And in certain cities, Elijah, it's as if the 2008 housing crisis never even happened. The property values are at those levels are higher than they were before that crisis. And then we have a commercial real estate bubble in the United States in many areas too. And the thing that's the scariest, Elijah, and central banks, I think the 2 largest markets they care about the most are currency exchange rates and bonds, besides manipulating interest rates. But that ties in with, currency exchange rates and the bond market as well. And so the bond market, Elijah, we now have, and talking with bond traders, this is just mind-boggling. We have European junk bonds, which a lot of these junk bonds, Elijah, these companies that are raising junk debt, will go bankrupt in the near future, next couple years. So normally the market prices in the risk of bankruptcy, and it's not doing that. And now there's lower yields, which means the market thinks that there's lower risk in European junk bonds because of all that European Central Bank quantitative easing. Their balance sheet is now larger than the Federal Reserve's. So the market now thinks that European junk debt has less risk than certain U.S. treasuries. So we've gone to just ridiculous levels on a lot of these other asset classes. And, gold and silver mine shares have not been the beneficiaries of this. So people who are owning this have put a lot of their money into this and not diversified, have looked very stupid for a while. But, that's what happens with a lot of markets is, there's just a lot of irrational behavior right now.
Now, moving to Eric, it seems, Jason brought up the idea that there's pretty much everything besides precious metals and precious metal mining shares are in a bubble. Now, some people might say that, well, look at the economy. We saw GDP this third quarter. It was just released that GDP was at a 3% annual rate instead of the expected 2.5%. And some people might say, well, hey, that actually the economy is doing well, so shouldn't the stock market and all these other asset classes also be doing well? What is your perspective?
Well, we have some expansion going on, and we see trade flows improving, and you can see blips like in the ISM survey that suggests that manufacturing is doing decently and whatnot. But the reality is that the corporate profits that are being generated by our economic activity have been in a funk for many years now. The underpinnings of the stock market's rise in price is not from earnings; it's from liquidity flows and from low interest rates, making it such that easy money flowing into the financial system has enabled prices to rise, and people are kind of on autopilot. There's more monies now flowing into the stock market based on automated trading systems and passive-based investing and ETF-based investing, and people are just kind of like going out to lunch and chasing whatever's going up, and the stock market is considered to be like a parking spot for cash because there's no way to get any kind of return on one's investment that's safe when it comes to savings accounts or bonds or whatnot. The retirement community is being decimated, so there's nowhere to run other than going into the stocks, and that's why stocks keep going up and up and up. That is the psychological underpinnings of a bubble, and that's where we are.
Yeah, to add to Eric's points there about financial repression, yeah, so people are going into the stock market. Some people, if they're desperate for income, are willing to pay almost any stock market valuation for any type of dividend yield. The other thing is a lot of these brand new hedge fund managers and traders working at investment banks, Elijah, they're only a couple of years older than you. They were not around even during the 2008 financial crisis. So they don't know what a bear market looks like. They haven't survived a bear market. So they only see buy the dips, it's in an uptrend. If you graduated from a major Ivy League business school, you worked at an investment bank for a couple of years, and things were in an uptrend, it's easy to make money in a bull market like that. So the old Wall Street saying is, don't mistake a bull market for brains. We have a lot of that right now. So I'm not trying to predict the exact top or exact crash of this, but what Eric said about the real economy is, what I would point out is that a lot of the problems in 2008 are even larger than they were in 2008. Nothing was really solved. Everything was papered over with more money and credit, many trillions of dollars in money and credit. And so problems that used to only be 10 billion, 100 billion, these problems, Elijah, in the real economy, in credit markets, are now over 1 trillion in size. And there's a lot of them.
Yeah, so let's put on our macroeconomic hat and expand this just for our audience's perspective. What's gone on since the 2008 crash has been that we've had over $10 trillion worth of liquidities pumped into financial systems from central banks. And that's created a lot of business activity and economic demand that basically is stealing demand from the future and pulling it into the here and now. Malinvestments left and right. You have, for example, the rescuing of the auto industry that happened after the 2008 crash, where, the big three in Detroit were going to go poof. And so the cheap money mechanisms saved those companies, and here we are with an auto inventory that's massive. And an excess bubble in auto finance credit markets to the tune of more than $1 trillion going now. We have so much demand from the future that has been stolen and stuffed into the here and now to create this illusion of a strong economy, and that's untenable when we have the credit mechanisms being pressurized with interest rates moving higher at some point in the future. People are going to be strapped, and their ability to function economically will disappear very, very, very quickly. And that's what will create the shift in the business cycle, and that's what the markets will respond to. And that's going to happen sometime within the next year, give or take, because just the duration of this move, second longest duration move in the stock market in history, economic expansion on par with the longest duration as well, and it's all based on liquidity, and it's vapor, or at least a major percentage of it is vapor. I'm not saying that the entire economic backdrop is artificial. That would be overstating the case. But obviously, when you dump up to $300 billion worth of liquidity into world markets every dang month, you're going to have a hell of a party.
And to add to Eric's points there, this has been October 2017 has been the least volatile month in stock. Has been the least volatile month in stock market history. So normally, if you go and look through stock market history in the past, there was a lot of big crashes in October. So you had the October 1929, Black Tuesday, the Black Tuesday crash that preceded the Great Depression. You have the last week was the 30-year anniversary of Black Friday, 1987, October 19th, 1987. Crash. So that was the 30-year anniversary. That was the last time that central banks didn't do massive hardcore intervention into the markets. And so there was a 22% down day in one day, the largest in history. But, within, I think, a couple weeks, the market had rallied pretty strongly. So this month, there's been the least amount of volatility on record. And a lot of this, Elijah, and this is something that hedge fund managers are talking about, but the mainstream financial media doesn't want to talk about it because they need to sell stock mutual funds and bond mutual funds to the people watching, and their sponsors, are all the financial service companies, the index companies, and the large banks that are selling these products. Is the leveraged short volatility trade, which hedge fund manager Christopher Cole says now is $1.5 trillion in size with leverage, and he has a lot of research to support this. So basically, there's this trade was piggybacked. This is initially the central bankers' intervention or plunge protection teams and exchange stabilization fund, and then so day traders, investment banks, hedge fund managers, financial institutions, they're not using their own money in a lot of cases. A lot of these guys would, when asked, said they wouldn't put any of their own dollars into this trade because how dangerous it is. But they're picking pennies off, a freeway during rush hour traffic, and so for basically since the 2009, they've made money on this trade. There was a day trader who just been shorting volatility on the VIX with short straddles, and also on the general stock market indices. He's turned $500,000 with leverage into $11 million since 2009. So they're running this guy's story. I just read that recently. He was a target manager. I'm sure he's a smart guy, but he's. If this leverage trade, if he has too much of his own money in this trade, he could blow up and end up owing more money than he ever made in the first place. And so this is the type of things people with the trend traders, people are doing these trades on leverage, and this is the markets we have now. With the other credit bubble I want to bring attention to your listeners is China. Eric mentioned $10 trillion. I think Eric's being modest. I would think the liquidity that central bankers have poured in, we know it's well over 18 trillion just from the G4 central banks with the Federal Reserve, Bank of Japan, European Central Bank, Bank of England. When you add in China has almost a 40 trillion US dollar credit bubble now. And all that money has not stayed in China. Whether you're a Chinese businessman who's corrupt or a corrupt Chinese Communist Party official, you've taken that money and you're speculating with Bitcoin and other cryptocurrencies. You've gone and bought real estate in some of those aforementioned places outside of China. You've taken the money out of the country and parked the cash. So, it's not there's a lot of gold bugs and silver bugs out there that think that China is going to save them. China is a lot of private sector Chinese citizens are buying physical gold. The People's Bank of China and other sovereign wealth funds in China are buying a lot of physical gold. But China, because they've done so much, I would say, stupid Keynesian central planning, trillions in misallocated resources, and all the corruption there, that they, even if the gold price went to $10,000 an ounce with all China's gold holdings, they would have a tough time paying back all their debt because they have such a large credit bubble there now too.
Now, one of the things I wanted to ask you about, Jason, was the GDP that I mentioned earlier. What do you think is driving this? You know, it's officially a 3% GDP for this, annually for this last third quarter. So why is it, higher than expected?
Okay, so the GDP statistics are constantly being tweaked and rejiggered. And the thing is that these things are always, Elijah, and this has been this way since I've been covering markets and I've learned about investing and economics and business really since 2007, is these things are always seasonally adjusted later. They're always revised downwards a month or two later. And normally the revisions, Elijah, are enormous. So we don't these numbers in general, I have a huge problem with GDP. I don't think it's real. But GDP is made up of government spending, consumer spending, investment, and exports. And so the U.S. Donald Trump has been getting some of these large deals done. He's been getting a lot of part-time jobs. I don't think the economy is creating a lot of high-paying full-time jobs. Donald Trump, when he ran during the election, he said this great rhetoric that, the Federal Reserve was manipulating interest rates lower. The stock market was a bubble. He was going to fire Janet Yellen. Remember him saying that the jobs and unemployment statistics were fake? Well, now he's saying the opposite. So either he was totally lying then, or he doesn't know what he's talking about now, or it's very, very dangerous. He set himself up, Elijah, to basically be the bag man if the global elites and the central bankers do allow a huge market crash for 6 to 12 months. So it'll be interesting to see what happens. So I don't think the GDP numbers are real. And, a lot of these deals with Donald Trump, whether they're the carrier deal that he was praising or the others, if you go back and check on these things that he was praising, as the election was coming around and he had won the election and he was transitioning into the inauguration, a lot of these things never came to fruition. And there was also, for a lot of these states, whether it's Foxconn going to Wisconsin or the carrier deal, there was a lot of subsidies needed. For the Foxconn deal in Wisconsin, I specifically looked at that one. I did a short video on my channel. There was over $1 billion in subsidies that are needed just to get Foxconn to bring mostly an automated factory there. So yes, there's going to be some human jobs, and they're going to be high paying, but it's not. We're not going back to the 1970s and 80s where there's thousands and thousands of factory workers anymore. A lot of these more modernized factories have a lot of robotics, a lot of automation, and the amount of human beings necessary at the factory are going to be a lot lower than in the past.
All right. Well, Jason Burak and Eric Dubin, thank you so much for joining us today. Before we let you go, did you want to share with the viewers, I guess starting with Jason, any last thoughts you had, and where can they find you online, Jason?
WallStreetForMainStreet.com, WallStreetForMainStreet.com. My YouTube channel also has over 3 million views and almost 20,000 subscribers, but because of YouTube censorship, I'm not sure how much more free content I'm going to be putting out. May only be one a week or so. But last thoughts is the dollar index is heavily manipulated. There's been huge swings with the dollar and the euro. I wanted to bring that point up. So not only do we have paper price manipulation in gold and silver markets, and there is strong physical demand in China and India and the Russian central bank, demand for physical precious metals by retail investors in the U.S. and Canada has basically collapsed. I think a lot of people have liquidated their physical gold, physical silver, and mining shares, and they're chasing either stocks or cryptocurrencies higher. And the other point I wanted to make is if you're patient, even in these low paper gold and silver prices, there are still winners in gold and silver companies, and those are the large royalty and streaming companies. So your Franco-Nevadas, your Royal Golds, your Wheaton Precious Metals, your Cisco Gold Royalties, and your Sandstorm Golds. These are companies that have good balance sheets, that have access to capital. They won't totally destroy their balance sheet or risk bankruptcy if they do a deal here. And so if the manipulators do keep prices at these levels for a little while longer or even lower, they will have cash to deploy for great long-term investments. And that's why you see the stocks of companies like Royal Gold and Franco-Nevada doing well the last couple of years, despite the paper precious metals prices not